welcome back. In the last session we have discussed about the roadmap, or otherwise we can say the roadmap or the timeline of the introduction of Ind AS in our country, and we have discussed about the various changes that happened during the implementation of Ind AS. Next, let us study in brief what are the Ind AS standards established in our country or issued in our country, which is followed in the preparation of financial statements of Indian corporate concerns. Ind AS, a set of IFRS converged financial reporting standards. Previously, we have been following a simple set of standards simply known as accounting standards, and it was in mandatory and it was in universal, or it wasn't similar to the universal standards that have been used worldwide. And after the convergence of the accounting standards of our country with the international accounting standards, otherwise known as IFRS, the new set of standards is known as Ind AS. We can simply say it as Indian Accounting Standards. So here are the list of IFRS corresponding to Ind AS. Since Ind AS is actually a converged form of accounting standards of our country with the IFRS, almost the international accounting standards and the accounting standards of our country is almost similar. Even the even the title of that particular standard as well as the number given for that particular standard is almost similar to the international standards, and there are slight changes in the number as well as the heading of some of the standards, but in most of the cases it is almost similar. So there is not much of a confusion regarding the Indian standards with the international standards. So International Financial Reporting Standards is a broad sense comprises of conceptual framework of financial reporting, IAS, IFRS, SIC and IFRIC. We have learned in detail each of these components of IFRS. IAS means International Accounting Standards and not Indian Accounting Standards. IAS means International Accounting Standard. These are the first set of standards that has been followed in throughout the world, and it was issued until 2001, and after 2001 and the new set of standards is known as IFRS. So any standards prior to 2001 is known as IAS, and any standards after 2001 is known as IFRS. And SIC, we have discussed about SIC and IFRIC. We are not going any further into the same topics which we have discussed in some of the previous classes. Anyway, we are just mentioning the components of IFRS includes IAS, IFRS, SIC and IFRIC. Anyway, we were discussing the main aspects of Ind AS. So here the list of IFRS corresponding to Ind AS notified by the MCA. MCA means Ministry of Corporate Affairs, and here is the serial number. Serial number is I believe you all know what is serial number. It doesn't have any relevance. Here IFRS bar IAS. I hope you all know what is the difference between IAS and IFRS. So these are the standards along with their numerical number, and here this column consists of the Indian accounting standards or accounting standards that has been followed in our country and the new set of accounting standards, and the name means what is the title of that particular standard. So there are around 45 including amendments and changes and mixing of certain standards has been happened until now. So we will go through in brief what are each of these standards, but as an activity you have to identify the full theoretical aspects of each of these standards. Previously we have learned about IFRS, IAS, SIC and IFRIC, but in case of Ind AS you have to learn all the standards that has been prevailing in our country until now, and what are the names of each of these standards and what are the peculiarity of each of these standards. Every standard has a scope, and an objective, why it is implemented, what is the purpose of each standard, where can be applied, why it is implemented, and for what purpose. So there are many aspects with regard to each of these standards. Right now we will have a brief discussion about each of these standards, but you have to identify the detailed theoretical aspects of each of these standards. I will share the link for finding out the theoretical aspects of each of these standards. Anyway, let us discuss each of one. First one, Ind AS 1. It is also known as IAS 1. IAS 1 means it is a standard that has been issued before 2001. So the standard that is issued before 2001, it will be like that. It is known as IAS 1. And here in India also, our first standard is Ind AS 1. It is known as presentation of financial statement. So what is meant by presentation of financial statement? Let us look into that. See, this is the site in which you can get the complete details of the standards which we have learned in this module. This is the official site of the Ministry of Corporate Affairs, which is otherwise known as MCA. It is a Government of India site, and here it will have the complete details of the accounting standards that has been followed in our country at the beginning, and after the convergence of our standards with the IFRS and the new set of standards, otherwise known as Ind AS, and there are certain amendments that happen in the Ind AS. Here the list of amended standards are shown here. You have to go for the latest one. See, you can easily identify the latest one on the base of the year mentioned here. So Indian Accounting Standards, otherwise known as Ind AS, not IAS. Remember that. Ind AS as on 1/4/2020. Here, first one. First time adoption of Indian Accounting Standard. That is the first standard. Here, see, if you click that link, you will get the detailed theoretical aspect of that particular standard alone. Likewise, you will get the complete details of all the Ind AS. Right now, we will discuss the scope of each standard, why that standard was introduced, what is the purpose of the standard. So, the objectives of this Ind AS is to ensure that the entity's first Ind AS financial statement and its entire financial report for part of the period covered by those financial statements contain high quality information. That is, any company who intended to present their financial statement as per the Ind AS, and this accounting standard emphasis on how the company can present their financial statement as per the Ind AS. That is the first one. First time adoption of Indian Accounting Standards. And as per this standard, the company that represents or presenting their financial statement as per Ind AS should comply with the standards set aside by Ind AS. Their first financial statements should be prepared as per the Ind AS, and after that, all the financial statement that is going to be prepared by the same concern must follow Ind AS. They can't change the Ind AS concept. They can't change the standards depending upon their discretion. Once they have started Ind AS, they have to present all their financial statements, because financial statement comprises of 5 or 6 statements. All statements must comply with Ind AS. And once Ind AS is followed, the company must follow the financial presentation of financial statement as per Ind AS. That is the first standard. Next one, Ind AS 2, or otherwise known as 102. This is known as share-based payment. From the title itself, you can easily identify what is the content of that standard. The share-based payments means usually the standard will contain the details regarding how the share transaction relating to the shares has to be adjusted, how it is to be recorded, and how it is to be treated and presented in the financial statement. The objective of the standard is to specify the financial reporting by an entity when it undertakes a share-based payment transactions. In particular, it requires an entity to reflect in its profit or loss and financial position the effect of share-based payment transactions, including expenses associated with transaction in which share options are granted to the employees. So, from the title itself you can easily identify what is the content of that particular standard, so it will be quite easy to study. Anyway, share based payments means any financial transaction, especially any payments in the form of shares. We have learned about transactions based on shares, and any transactions based on shares, especially the payment with regard to shares, such transactions should be recorded as per the norms and standards set aside by the Ind AS. And not only that, any expenses related with the share based transactions should be properly recorded in the income statement otherwise known as profit and loss account. So the company that follows any financial transactions based on share, it should be properly comply with the Ind AS, and Ind AS 102 basically deals with share based payments. Next one, business combinations. Here, business combination, you might have hearing it for the first time. Actually, business combination is a term given to the transaction relating to takeover. In the last session, I have mentioned about parent company, subsidiary company, and takeover of one company by another. Such type of dealings or financial transactions is known as business combinations. So whenever there is a transaction relating to business combination includes any transaction that comprises of parent company, subsidiary company, joint ventures, takeover of one company by another, or companies, two or more companies join together. When such kinds of transactions or business deals occur in a company or in a business, Ind AS 103 basically deals with such kinds of transactions. It is given as business combination, and it will have the detailed description about how the transaction has to be done in case of such types of transaction where transactions of parent company, subsidiary company comes. Their financial statements is prepared in a very peculiar manner, unlike the financial statement we have been prepared until now, or which we are going to learn anything in the future in your degree classes. The financial statements of holding company, subsidiary company, or just simply say business combination transaction, it is completely different from the financial transactions or financial statements you have learned until now. It is a peculiar pattern of presentation. You will learn about that peculiar pattern of presentation in your higher studies, in your PG classes and post PG classes. Anyway, any transaction relating to such type of dealings or business combination, Ind AS 103 specifically mentions about what are the steps that has to be followed while dealing with business combination transaction. For example, there is during such kinds of dealings, there is a peculiar method for computing the goodwill arising from that business combination dealings, and how the minority interest can be calculated. You might have hearing the term minority interest for the first time. There are many peculiar terms relating to business combinations, and you will learn about those business combination and its further aspects in your higher studies. Anyway, remember Ind AS 103 deals with all sort of business combination transactions. Next one, insurance contracts. From the term itself, you can easily identify what will be the content of that particular standard. Definitely, it will have the details of insurance dealings. So, let us go into that. The objective of this accounting standard is to specify the financial reporting for insurance contracts by an entity that issues such contracts. So, any business or a firm or a corporate concern that deals with insurance contract must comply with Ind AS 104. It will have the specified details or steps that has to be followed in an insurance contract between a insurer and the insuree. how these transactions has to be represented in the financial statement. All these aspects will be specifically mentioned in this particular standard, that is Ind AS 104. Next one, non-current assets held for sale and discontinued operation. The objective of this standard is to specify the accounting for assets held for sale and the presentation and disclosure of discontinued operations. Actually, these are related with corporate concern activities. You will be hearing this for the first time. Anyway, any transaction relating with non-current assets, or we can say fixed assets, any sale and exchange of fixed assets, such kind of businesses dealt by a company, such concerns or corporate concern or companies has to comply with Ind AS 105 in order to present the transactions relating to non-current assets held for sale in the financial statement, and it will specifically mention what are the objectives that has with regard to that particular standard, and what are the areas this standard is going to cover, and that is mentioned under the scope. And it will specifically mention what are the steps that has to be followed while company deals a sale of non-current assets. So Ind AS 105 specifically deals with the sale of non-current assets held by the concern. Next one, Ind AS 106, exploration for and evaluation of mineral resources. And one more thing, if you go through the slide which we have shown at the beginning of this session, you might see that some of the standards we have discussed now is missing in that slide. Don't worry about it. Actually, in that slide it was showing the standards that has been used or implemented at that time. Means it is a printed statement, so after the date of printing there might have been any updation in the standards, and here the site keeps on updating the standards that has been followed in our country. So it's better to go through the standards mentioned in this particular site, because it is the official Government of India site that is controlled by the Ministry of Corporate Affairs. So it is better to follow the standards shown here rather than the slide which has shown in the beginning of the session. Anyway, exploration for evaluation of mineral resources. As the term suggests, you might get confused. You might be hearing this for the first time. Many of the concerns might have been dealing with excavations and exploitation of natural resources or mineral resources. Very big corporate concern might be dealing with mineral resources, and such corporate concerns that deals with mineral resources has to comply with Ind AS 106 in order to identify these items and presenting these items in the financial statement. How these items have been explored and how these can be evaluated and valued in financial terms, and it can be presented in a financial statement. And Ind AS 106 specifically mentioned about exploration for and evaluation of mineral resources. The main purpose of this standard is how these minerals are evaluated, how it can be presented in a financial statement without any issues, in order to ensure transparency and make confidence in the minds of users of financial statement. Next one, financial instruments disclosure. This statement or this standard specifically mention about how the corporate concern or a company that follows an Ind AS should present their financial statements in such a way that the financial instruments utilized by those corporate concerns should be properly disclosed in the financial statement. There should be transparency in the presentation of financial instruments used by the concerns in their financial statement. This ensures and improves the confidence of the users because users invest their money in the business. In the business means in the financial instruments of that concern only on the basis of the information provided by the financial statement of that particular concern. So, such financial statement should provide a transparent information about the financial instruments such as debentures, shares like that, promissory notes like that. So, the statement should provide what is the risk associated with those instruments, what are the possibilities of risk that is going to be faced in the future with regard to that particular instrument. So, such information is necessary for investors to take decision whether to invest in the financial instrument of that concern. So, in order to make the decision, the financial statement should provide sufficient information. So, it should disclose everything. So, that is the aspect with regard to Ind AS 107. Next one, operating segment, otherwise known as Ind AS 108. Operating segment is a part of or a department of a concern or a company or a corporate that works under that same institution or a company or a corporate with ultimate objective of earning revenue. Some of the departments or the segments may not be earning revenue, they may be working solely for the purpose of providing any assistance to the concern or a corporate. Anyway, operating segments specifically mention how the segment of a concern is operating, and here the standards brings transparency in the activities of segments of the concern. Segment simply means a part of the concern, or we can simply mention that a department of a concern, production department of a concern, or sales department of a concern, marketing departments of it. That are examples of segment. So operating segments means any part of the company that operates with the objective of earning revenue. Such activities or the activities of such segments should be presented in the financial statement as per the Ind AS 108. Next one, Ind AS 109, financial instruments. Ind AS 109 deals with financial instruments of a concern. A financial instrument are assets that can be traded, or they can also be seen as a packages of capital that may be traded. Most types of financial instruments provide efficient flow of transfer of capital all throughout the worlds of investors. These assets can be cash, or it may be a contractual right to deliver or receive cash, or any other type of financial instruments, or evidence of one's ownership of entity. You will learn in detail about the financial instruments of a concern in your higher studies. There are two types of financial instruments: cash instruments and derivative instrument. And derivative instrument basically deals with the share market aspects, and Ind AS 109 deals with how the financial instruments of a company has to be dealt, and how the transaction relating to financial instruments has to be present in the financial statement of that concern. Ind AS 109 specifically deals with financial instruments of the concern. Ind AS 110, otherwise known as 110, deals with consolidated financial statement. Consolidated financial statement means the combination of two or more financial statements of two or more companies. That is known when we join together and present the financial statements of one or more company, it is known as consolidated financial statement. So what is the need for presenting the financial statements of two or more concerns into one single financial statement. It occurs basically during business combination transaction. I believe we all know what is meant by business combination. That is, one company might take over another company, or two companies join together and form a new company, or two companies join together and form a new pattern of company. So there are different types of combinations. That is known as business combination. So once one company is taken over by another company, for the time being, let us study that example. One company takes over the another company. Once it is done, the new financial statement comprises of the items of the company which has taken over and the company that is taken by the main company, or we can simply say the terms parent company and subsidiary company. I believe you all know what is meant by parent company and subsidiary company. Parent company means the company that is going to take over another company is known as parent company. Subsidiary company is company that is taken over by the parent company. So when these two companies join together, the various items or elements of the financial statements of these two companies has to be presented in one single statement. So this accounting standard, that is otherwise known as Ind AS 110, deals with consolidated financial statements. So when the consolidated financial statements of these parent subsidiary company occurs, they have to comply with the Ind AS 110. Next one, Ind AS 111, otherwise known as joint arrangements. Ind AS 111 deals with joint arrangement. Actually, from the term itself, you can easily identify what is the content of the joint arrangement. That is, the financial statement that is prepared on the basis of an arrangement between two or more companies. Sometimes two or more companies join together as an arrangement in between those parties, and the financial statement presented by those concerns, that has to be presented as per the Ind AS 111. Usually joint arrangements occur when joint arrangements we can simply say as joint ventures. So when one or more companies or two companies join together and under an arrangement or an agreement on the basis of a contract, it may be a contractual agreement between two or more companies to work together for any particular purpose. Such activity is known as joint venture, or we can say joint arrangements. So financial statement of such joint ventures should be complied with Ind AS 111. Next one, Ind AS 112 or Indian Accounting Standards 112 deals with disclosure of interest in other entities. Here it is specifically mentioned that the objective of this Indian Accounting Standard or Ind AS is to require an entity to disclose information that enables users of its financial statement to evaluate the nature of risk associated with its interest in other entities and the effect of those interests on its financial position and the financial performance and cash flows. And this standard specifically mentions that it should disclose any information relating to the disclosure of interest in other entities, so that any risk associated with those interests and also the effect of those interests in their financial position. Not only financial position and also in the financial performance or any changes in the cash flows. It may be an inflow or an outflow of the entity. It should be specifically comply with the Ind AS 112. Next, Indian Accounting Standard or otherwise known as Ind AS 113 that deals with fair value measurement. Usually fair value usually arises in case of valuing an asset or a liability with regard to the existing or prevailing market condition. See, the objective of fair value measurement in both the cases. In the previous sentence, it has mentioned about two situations. Anyway, the objective of fair value measurement is to estimate the price of which an orderly transaction to sell asset or to transfer the liability would take place between market participants at the measurement date under the current market conditions. That is the main aspect. The valuing of assets and liabilities that are meant to be transacted between any two parties, it should be valued in a fair value measurement concept, that is the market value of that particular item prevailing at the current period. And Ind AS 113 deals with fair value measurements of exchange of assets and liabilities. Ind AS 114 deals with regulatory deferral accounts. You might get confused with standard because it is actually relating with public companies. So, what is a regulatory deferral account? A regulatory deferral account is an amount recognized by a price regulated entity or a concern or a company that regulates the price of its goods and services. For example, the best example is KSEB, Kerala State Electricity Board, because the rate regulations are controlled by the KSEB, who is the supplier of electricity in our state. They know what are the costs for generating electricity that is to be supplied to the general public, and the price is charged by the KSEB to the retail customers subject to the approval of rate regulator. They can't simply charge a price for the service or goods provided by the KSEB, but the price is fixed by the KSEB, but it should be complied with a rate regulator. So, presentation of financial statement with regard to those regulatory deferral accounts, that is just an example I have mentioned here, the activity of a KSEB. And this standard is applicable when the price of goods and services that are subjected to rate regulation. There may be changes in the rate, or it may be controlled by a certain person, usually the supplier, and the changes in the rates will be complied as per the rate regulator. So all these aspects with regard to regulatory deferral accounts will be stated in the Ind AS 114, and the financial statement with regard to those areas has to be complied with Ind AS 114. Ind AS 115 deals with revenue from contracts with customers. Actually, this standard deals with contract transactions, especially with the customers. The objective of this standard is to establish the principles that an entity shall apply to report useful information to the users. Users usually will be customers of financial statements about the nature, what is the nature of their business, what is the amount they had invested in the business, timing and uncertainty of revenues, timing and uncertainty, what is the discount factor with regard to the cash flows arising from a contract with a customer, and all those aspects with regard to any of the contracts that is engaged with the customers should be duly complied as per the Ind AS 115. Next one, Ind AS 116 deals with lease or leases. Ind AS 116 deals with leases. I believe we all know what is meant by leases. A lease is an agreement whereby the lessor conveys to the lessee in return for a payment or a series of payments the right to use an asset for an agreed period of time. So that is known as lease. The majority of the students might have heard about the term lease. So any transaction that deals with leases or a lease between a lessor and a lessee, and any financial transaction relating to those leases should be presented in the financial statement as per the Ind AS 116 compliance. So this standard set out the principles for the recognition, measurement, presentation and disclosure of leases. The objective is to ensure that the lessee and lessor provides relevant information in a manner that faithfully represents those transactions. It is an understanding between two parties. So there should be utmost faith between these parties. The information given gives a basis for users of financial statements to assess the effect that leases have on the financial position, financial performance and cash flows of an entity. The concept is if the company is dealing in any of the leases or lease, it should comply with the Ind AS 116 so that the financial statement will be transparent regarding the transaction relating to the lease, because the financial statements are used by internal users and external users, and it give a clear picture about what is the nature of the lease the company has dealt with, what are the risks relating to those leases, and what are the gains or revenues with regard to those leases. So accordingly, the investors can either decide to invest in that business or not. So Ind AS 116 deals with transactions relating to leases. So these are the accounting standards that are issued after the convergence of accounting standards of our country with the IFRS. That is Ind AS 101 to 116. After that, it will be the Ind AS 1, that is actually the earlier accounting standards, but now it is known as Ind AS 1, and there might have been changes in each of these standards. There might be some amendments in each of these standards. Some of the standards may be cancelled or suspended. Anyway, follow these standards that is mentioned under the official Government of India site of Ministry of Corporate Affairs. We will discuss about the Ind AS 1 onwards in the coming sessions. Until then, go through these standards and try to learn the point from this particular site. It will be much better. So if you have any queries with regarding to that, please let me know. We will continue with the rest of the Ind AS standards in the coming session.